Warren Buffett is sitting on $325 billion in cash, the largest cash position in Berkshire Hathaway's history. Not millions, not billions. $325 billion doing absolutely nothing. When the greatest investor of our generation refuses to invest, what does he know that the rest of us don't? Because right now, while markets hit record highs and economic headlines celebrate resilience, something terrifying is happening beneath the surface. Three massive bubbles are inflating simultaneously: stocks, real estate, and bonds, creating a financial superstorm unlike anything we've seen before. Not since 1929, not even 2008. This is different, and the warning signs are everywhere if you know where to look. Let's start with what makes this moment so uniquely dangerous. In 1929, we had a stock market bubble. In 2008, it was real estate. But today, we're watching all three asset classes inflate at the same time, while something even more disturbing happens in the background. The very tools that saved us during previous crashes have been completely exhausted. The Federal Reserve's ammunition is gone. Government debt has exploded to levels that would have been unthinkable just 15 years ago. And the smart money people like Warren Buffett, hedge fund managers, institutional investors, they're all moving to the exits at once. The question isn't if this bubble will burst. It's when, and more importantly, are you prepared for what comes next? Think about the last major crash in 2008. The S&P 500 dropped 57% from peak to trough. Millions of Americans lost their homes. Unemployment hit 10%. Lehman Brothers collapsed. Bear Stearns vanished. AIG required the largest government bailout in history. It was catastrophic. But here's the terrifying truth. The Federal Reserve had room to act. Interest rates in 2007 were at 5.25%, which meant the Fed could slash rates to zero and inject trillions into the economy through quantitative easing. It worked. Markets eventually recovered. But what happens when the next crisis hits and rates are already near zero? What happens when government debt is so massive that additional borrowing becomes impossible? What happens when the Fed's balance sheet is already bloated from years of money printing? We're about to find out. Right now, the stock market is trading at valuations that haven't been seen since the dot-com bubble of 2000. The Shiller pay ratio, measured that compares stock prices to earnings over a 10-year period, is sitting above 30. Historically, the average is around 16. The only times we've exceeded these levels were right before the 1929 crash, the 2000 tech bubble, and 2008. Every single time, catastrophic losses followed. But investors today seem convinced that this time is different. They point to AI innovation, technological disruption, corporate earnings growth. They ignore the fact that margin debt money borrowed to buy stocks has reached record levels. They ignore that insider selling has accelerated dramatically while insider buying has dried up. They ignore that small-cap stocks and mid-cap stocks have been underperforming massively, suggesting the rally is dangerously concentrated in just a handful of mega-cap tech companies. When the foundation cracks, the entire structure collapses. Let's dig deeper into what margin debt really means. When investors borrow money to buy stocks, they're essentially betting that their returns will exceed the cost of borrowing. It's leverage. And leverage works beautifully in rising markets. A 10% gain becomes a 20 or 30% gain when you're using borrowed money. But the reverse is also true. When markets fall, losses are magnified. And right now, margin debt levels are approaching the peaks we saw right before the 2000 and 2008 crashes. Investors are so confident that they're willing to borrow hundreds of billions of dollars to chase returns. This is classic light cycle behavior: euphoria, overconfidence, the belief that markets only go up. But history shows that when margin debt peaks, crashes follow within months. The selling pressure becomes overwhelming. Margin calls force investors to liquidate positions at any price. Panic spreads, and what starts as a correction quickly spirals into a full-blown crisis. Corporate insiders are also sending unmistakable signals. These are the people who know their companies better than anyone: CEOs, CFOs, board members, major shareholders. And they're selling at a pace we've rarely seen before. According to recent data, insider selling has outpaced insider buying by more than 8 to 1. Think about that. The people running these companies are dumping their own stock. The CEO of Nvidia, one of the biggest winners in the AI boom, sold hundreds of millions of dollars worth of shares. Jeff Bezos liquidated billions in Amazon stock. Mark Zuckerberg has been steadily selling Meta shares. These aren't routine diversification moves. These are calculated exits at peak valuations. They're taking profits while retail investors pile in, chasing momentum. It's the classic pattern of every bubble. Smart money sells to dumb money at the top. But stocks are just one piece of the puzzle. Let's talk about real estate. The housing market has been on a tear since the pandemic, with prices rising at rates that far exceed income growth. In many major cities, the median home price is now 10 times the median household income. Historically, that ratio has been between 3 and 4. Affordability has collapsed. First-time home buyers are being priced out of the market entirely. Yet somehow, prices keep climbing. Why? Because interest rates were kept artificially low for over a decade, flooding the market with cheap money. investors, institutions, and foreign buyers snapped up properties, treating housing as a financial asset rather than a place to live. But now, with rates rising rapidly and mortgage payments soaring, the music is about to stop. Here's what makes the housing situation so precarious. During the 2008 crash, subprime mortgages were the problem. Banks had lent to borrowers who couldn't afford their homes, and when those loans defaulted, the entire financial system seized up. Today, the lending standards are tighter. People aren't getting loans they can't afford, at least not in the same way. But there's a different problem. Existing homeowners are locked in. If you bought a house in 2020 or 2021 with a 3% mortgage, you're not going anywhere. Selling means giving up that low rate and refinancing at 7 or 8%. So inventory has frozen. Homes aren't coming onto the market, but at the same time, prices are so high that new buyers can't afford to enter. It's a standoff. And when something finally breaks, when job losses force people to sell, when adjustable rate mortgages reset, when speculators panic, the cascade will be swift and merciless. Prices will fall, equity will evaporate, and millions of homeowners will find themselves underwater, owing more than their homes are worth. The commercial real estate market is even worse. Office buildings in major cities are sitting half empty as remote work becomes permanent. Occupancy rates in places like San Francisco, New York, and Chicago have plummeted. But these buildings were financed with massive loans based on pre-pandemic valuations. Those loans are now coming due, and property owners can't refinance because the buildings aren't worth what they used to be. Banks are starting to take losses. Defaults are rising. And because commercial real estate is deeply interconnected with the banking system, this could trigger a cascade of failures. Regional banks, which hold a disproportionate share of commercial real estate loans, are especially vulnerable. We already saw the collapse of Silicon Valley Bank and Signature Bank. In early 2023, that was just the beginning. More banks will fail as commercial real estate losses mount, and then there's the bond market, which almost no one talks about but might be the most dangerous bubble of all. For decades, bonds were considered the safe part of your portfolio, steady returns, low risk, a place to park money when stocks got volatile. But something unprecedented has happened. Bond prices have crashed while stock prices surged, violating one of the most fundamental rules of diversification. Why? Because inflation surged and central banks were forced to raise interest rates at the fastest pace in 40 years. When rates rise, bond prices fall, and for investors who thought bonds were safe, the losses have been staggering. The Bloomberg Aggregate Bond Index, a benchmark for the bond market, fell nearly 20% in 2022, one of the worst years in bond market history. Retirees who thought they had secure, stable income saw their portfolios decimated. Pension funds took massive hits. Insurance companies, which hold billions in bonds, saw their balance sheets deteriorate. But here's the real danger. Governments around the world have issued record amounts of debt at low interest rates. As those bonds mature and need to be refinanced at higher rates, the cost of servicing that debt will explode. Countries will face a choice: default on their obligations or print money to cover the gap. Either option leads to disaster. Defaults trigger financial contagion. As creditors panic and liquidity dries up, printing money leads to inflation, eroding purchasing power, and destroying savings. We're watching this play out in real time. Countries like Japan, with debt-to-GDP ratios exceeding 250%, are trapped. The Bank of Japan tried to raise rates and had to reverse course within weeks because the government couldn't afford higher borrowing costs. The European Central Bank faces similar pressures, and the United States, despite being the world's reserve currency, is not immune. Now let's talk about the elephant in the room: the $36 trillion national debt. Just 20 years ago, U.S. government debt was around $6 trillion. It has sextupled in 2 decades. To put that in perspective, the debt-to-GDP ratio now exceeds 120%, a level historically associated with economic decline and crisis. During World War II, debt reached similar levels, but the economy was growing rapidly, and the U.S. was the world's undisputed manufacturing powerhouse. Today, growth is anemic, deficits are structural, and political gridlock makes fiscal reform nearly impossible. Every year, the government spends more than it collects, adding another trillion or two to the pile. And as interest rates rise, the cost of servicing that debt skyrockets. In 2024, the U.S. government will spend over $1 trillion just on interest payments, more than the entire defense budget. That's money that can't be spent on infrastructure, education, healthcare, or anything else. It's simply gone, paid to bondholders, many of whom are foreign governments. This is unsustainable. And when creditors lose confidence, when they start demanding higher yields to compensate for risk, the death spiral begins. The yield curve has been screaming warnings for over a year now. For those unfamiliar, the yield curve measures the difference between short-term and long-term interest rates. Normally, long-term rates are higher because investors demand more compensation for locking up their money for decades. But when the curve inverts when short-term rates exceed long-term rates, it signals that investors expect an economic contraction, and the yield curve has been one of the most reliable recession indicators in history. Every major recession since 1950 was preceded by an inverted yield curve. No exceptions. And right now, the curve has been inverted for months. The market is telling us that trouble is coming, but politicians and central bankers keep insisting everything is fine. They point to low unemployment, strong consumer spending, resilient corporate earnings, but these are lagging indicators. They tell you where the economy was, not where it's going. The yield curve is a leading indicator. It predicts the future, and it's predicting a crash. Meanwhile, the smart money is acting very differently from what they're saying publicly. Warren Buffett's $325 billion cash pile isn't an accident. Berkshire Hathaway has been a net seller of stocks for multiple quarters, trimming positions and raising cash at a pace we've never seen before. Buffett has said publicly that he can't find attractive investments at current prices. Translation: everything is overvalued. He's preparing for the crash, positioning himself to buy assets at a massive discount when panic hits. And he's not alone. Hedge fund managers have been reducing equity exposure. Ray Dalio has warned about the risks of holding cash and bonds as governments devalue currencies. Paul Tudor Jones has been buying gold and Bitcoin as hedges against monetary instability. Michael Burry, who predicted the 2008 crash, has been vocal about the dangers of passive investing and index fund bubbles. These aren't random opinions. These are calculated warnings from people who have navigated multiple market cycles and understand how crashes unfold. Consumer behavior is also flashing red. Credit card debt in the United States has surpassed $1 trillion for the first time in history. Delinquencies are rising. Savings rates have collapsed. Pandemic-era stimulus has been spent. Student loan payments have resumed. Consumers are tapped out, but the economy is still being held up by spending. What happens when that spending stops? Retailers report weaker sales. Auto loans are defaulting at higher rates. Buy no pay later services are seeing increased missed payments. The average American is one unexpected expense away from financial crisis, yet stock markets keep hitting new highs. The disconnect between Wall Street and Main Street has never been wider. The wealthy, who own most of the stocks and real estate, are thriving. But the bottom 50% of Americans have seen their real wages stagnate for decades. Inequality is at levels not seen since the 1920s, and history shows that extreme inequality is a precursor to economic instability and social unrest. Corporate earnings are also starting to show cracks. Big tech companies have driven the majority of market gains, but beneath the surface, earnings revisions are turning negative. Companies are missing revenue targets, profit margins are compressing, cost-cutting and layoffs are accelerating, and yet, stock prices remain elevated because investors are betting on a soft landing, a scenario where inflation falls. The economy avoids recession, and corporate profits rebound. It's a beautiful story, but it's also a fantasy. History shows that once inflation spikes and central banks are forced to tighten, recessions almost always follow. The idea that we can avoid that outcome this time requires believing that the rules of economics have fundamentally changed. They haven't. The business cycle still exists. Booms still lead to busts. And the longer the boom, the more severe the bust. Geopolitical risks are also escalating in ways that could trigger financial contagion. Tensions between the US and China are at multi-decade highs. The war in Ukraine continues with no end in sight. Middle East instability threatens energy supplies. Deglobalization is fragmenting supply chains. Countries are moving away from the US dollar as the world's reserve currency, a shift that could have profound implications for American economic dominance. If confidence in the dollar erodes, if foreign governments start dumping US treasuries, the financial consequences would be catastrophic. Interest rates would spike. Inflation would surge. The standard of living for average Americans would collapse. These aren't hypothetical risks. They're real, present dangers that could materialize at any moment. The world order that has existed since World War II is fracturing. And when the global financial system loses its anchor, chaos follows. So what does all this mean for you? If history is any guide, the next crash will wipe out trillions of dollars in wealth. Retirement accounts will be decimated. Home values will plummet. Unemployment will surge. And unlike previous crashes, the government won't have the tools to engineer a quick recovery. Interest rates can't go lower. Debt levels are already unsustainable. Political dysfunction makes coordinated fiscal policy nearly impossible. The safety nets that saved us before won't be there this time, which means the downturn will be deeper, longer, and more painful than anything we've experienced in our lifetimes. The crash is coming. The only question is whether you'll be ready when it does.